Um, yeah, so today, as I said in my last workshop, today we will talk about technical analysis. Uh, the last day, like last Wednesday, we did fundamental analysis, and today we are gonna focus on technical analysis. Now, every investor is a very different kind of an investor, right? And like we have spoken about, it depends on who they are, what kind of biases they bring to the table, what kind of risk appetite they bring to the table. So for some investors, fundamental analysis would be very important for them to invest. And for some investors, they would be okay with the technical analysis too. Now, if you ask me, I'm a guy who definitely does fundamental analysis before investing. And but if you're looking for like understanding how to predict how the stock would move or how to kind of look at the technical part of stock analysis, yeah, this is something that you should look out for. Um, Having said that, I wanted to start today with a great so it's not a story per se, but one of the Wharton professors that I love a lot. He's amazing. He's an amazing finance professor. Uh, he told me that Anomitra financial statements, like we saw in the last workshop, are nothing but a reflection of the business, right? And so it's very important to understand the business. It's very important to understand who are the customers of this business. Very important to understand what are the levers of this business before you actually go ahead and invest in that business or invest in that company, right? So I'm a guy who believes deeply in fundamental analysis before investing. But having said that, today is all about the technical analysis. And I'll try to end 15 minutes early so that I have the last 15 minutes for Q&A and to answer any or all questions you might have. And yeah, so let's get started. Great. So when we talk about technical analysis, right, like everything else in life, stocks have a pattern. And again, like everything else in life, it's very important to have or understand pattern recognition to understand how the stock would move in the future. And that's what we are going to figure out. So when we say we are going to learn more about technical analysis, what I mean is that it's a method to evaluate stocks and securities by looking at the statistics generated, by looking at the statistics that we have figured out from the historical market patterns, right? We would look at price movements, we would look at patterns that drive these stocks. And so again, you can be a fundamental investor, or you can be a technical investor, or you can be both, right? But technical investors would look at different things in the stock, right? Like they wouldn't really focus on the company as much as they would focus on how the stock is performing. They would look at the historicals to figure out how to move it or how to project it in the future. How it can be helpful for most technical investors, how this analysis could help is it gives you an understanding of the trends in the market. It gives you a direction, right? It tells you that, okay, is this stock gonna go up or is it gonna go down? This analysis is going to answer that question for you. it is really, really helpful for spot trading opportunities. Like, say, for example, there are a lot of people who are intraday traders. Now, intraday traders are like people who start trading when the market opens and finishes the day when the market ends, right? So they come in, they trade throughout the day, they buy a bunch of stock, they sell a bunch of stock, and all of their analysis is dependent on how the stock or the bunch of stocks that they're buying would move throughout the day, right? They're not long-term investors. They're not they're not people who are going to hold on to their investments for like a month. Like that's the lowest, a month. I'm not even talking about like 3 years, 5 years, or 10 years. So now, normally what these folks do is that like some of you who are part of the global youth meetup, you guys would get like say $25,000 of cash, right, to buy the stocks. So say in the morning when you start trading, you get $25,000 to buy any number of stocks. And then by the evening, before the market closes, before the bell rings, you have to sell whatever you have bought and then analyze if you made a profit or you made a loss. So spot trading opportunities are very, very important. Like technical analysis is very important for spot trading opportunities. Um, Third would be about managing risk, and the last would be about improving timing. So uh, the technical analysis, this kind of analysis actually helps traders, understand and take a call on when they want to enter the market, which stocks they want to enter the market into it, and how they want to exit, and what would be their strategy of exiting, so that they can maximize their profits and minimize their losses. So just like anything else in finance, we have to understand what are the underlying principles of technical analysis, like what entails or what supports technical analysis. The first, basically, there are three key principles, out of which the first one is that the market discounts everything. So I think I've told you this over my last three sessions that uh, the market is God, the market is king. The market price of any security reflects all available information that the market has about that security. So, say, for example, Walmart plans to go into, say, a new country. Say Walmart wants to um, expand operations into Brazil, right? And you feel like, oh, so because they are gonna go into Brazil, they're gonna sell more than they are selling now because it's a new geography, so they're gonna sell more products and they're gonna get more revenue, and hence their stock price might grow, right? Uh, but when you're buying the stock, just understand that the market has already factored in the fact that they are getting into Brazil. So the market shows you the price of every information that is available about that stock factored into the price. So until and unless you know something that the market does not know, bear in mind that the market knows everything about the stock and has already factored in all of these when it prices the stock. Second key principle about technical analysis is that price moves in trends. So, which means that price movements are not entirely random. It's not like suddenly Walmart would pop and say Kroger's would come down, or suddenly say there would be crazy movement in an Nvidia stock, whereas there would not be any movement, say in the Google stock, right? So price movements are not random. They basically follow trends that persist for a certain period, right? Like, for example, right? As we all know, what's the recent trend that's going on in the market, right? AI. So every company that's building for AI, every company that's leveraging AI into their products is getting an uptick movement, right? And that's why we see that in the market right now, the tech sector is outperforming any other sector because there's a trend that's started and people are following that trend and people are pricing it in a sustainable way. And the third would be that history tends to repeat itself. Uh, there will always be, and we have an entire session on behavioral finance where we'll see that the market does have similar behavioral patterns and when in similar conditions. So like like to say that you need to know your history to better perform in the future because the history will predict the future. And that's what happens in the market too. The historicals of the market will predict how the market will feature in the future. And so these three are the main three principles that will guide your technical analysis. And we will look at different recurring patterns in price movements. We'll look at different ways to understand price movements and we'll look at how we can be or get better at performing technical analysis. So let's first learn how to interpret a stock chart, right? Like you cannot do a technical analysis if you don't know how to read a stock chart, right? So there are basically a few different types of charts. One is called a line chart, which basically goes like this. We have all seen them, right? Normally, if you log on to, say, Robinhood or any other broker company which shows you how a stock price is moving, or even if you go to like Google Finance or Yahoo Finance, it will shows how a stock price is moving. Normally, they will use line charts. It's the simplest form of chart. It kind of shows you where the stock was at certain point of time and where the stock is today. And it shows you how the stock has performed over a fixed period of time. So it can be in the last 1 month, it can be in the last 1 year, 3 years, 5 years, 10 years, right? Kind of gives you a brief overview of how it has panned out. It gives you a very clean view. But one of the things that a line chart really lacks is details about how the price moved between, say, definitely between intraday for sure, but also between, say, days, between weeks. Because, like, say, for example, the more broader you go, the more you know not the data is more pushed into certain factors, right? Like if you're looking at last 10 years data, they would basically show you how it was in 2014, then what happened in 2015 to 16, and then to like say 24, right? Whereas if you go to the last month, they would rather show you say week by week, what was the price on week one of June and what is the price of the stock or the security on week 4 of June. So the granular you go, the better it is. But then again, line charts will never give you uh, more understanding of how the price moved intraday. Then we have bar charts. So each bar represents kind of one trading period, so which is like 1 day, and shows basically 4 key price points. So it will the top portion will show you the top of the bar will show you the highest price that it has gone to, and the lowest is the basically the lowest price it has gone to, right? Like say for example, say yesterday Amazon opened at somewhere around I think 192 or something if I'm not wrong, and then it went up to I think 200 plus. It went to 200, 201, and so basically 201 would be the high and 192 would be I think it did not go beyond 192, I think. Yeah, then 192 would be the low, and the left tick actually shows you the opening price, the price what was the opening price of the security. So the opening price might be 192, might be 193, might be 194. And the right tick kind of shows you the closing price. It shows you where the price ended for the day. And it kind of gives you a very good view of what happened throughout the day to the stock, right? It kind of tells you how much of a movement did the stock have throughout the day? Like, what was its high, what was its low, where did it start from, and where it ended? So basically, you have a decent understanding of how much volatility is there in the stock, like how much up and down the stock went, right? And then we have candlestick charts, right? Basically the body represents the range between the open and closing prices, and then we have the wicks. Basically, if you see the chart on the right, you'll see the wicks, the upper wick and the lower wick. So the upper wick shows you the high, and the lower wick shows you the low prices. So bar charts and candlestick charts are much better in understanding how intraday prices have moved, rather than line charts. And so candlestick charts or like bar charts, if you see a green chart, if you see that this chart is green, it means that the close was higher than the open. And if you see it's a red, which means that the close was lower than the open, which just means that basically uh, in another way, you can say a red means that people sold that stock more that day, and green means that people bought the stock more that day. Or in a way, you can mean you can sense that a green chart means that the stock actually went up throughout the day, and the red chart means that the stock actually went down throughout the day. Now, if you are an intraday trader, right, and over the last 1 week, you see that there are a lot of these red candlestick charts, right? And there is no new data in the market. There's no new information in the market. What does it tell you about what the chart would look like tomorrow? And you can like put in your answers in the chat. Anyone? No? Uh, well, it was definitely a not so easy question, but it more means that there's a high chance that the next day would also be red, because kind of tells us that if for the last 7 days people have been selling and there's no new information in the market, people would also sell the next day. And so when we look at interpreting a stock chart, we would look at the different components of the chart, right? Like the open, the high, the low, the close, and the volume. The volume tells a lot of things, and we're going to dive into it in a bit. But before I dive in, I wanted to ask if any one of you had any questions on what I went through for so far. Like, if you have any questions on the bar chart, any questions on the candlestick chart, any questions on the open, the close, the high, or the low. Any questions that you guys have? You could just put in your questions on the chat. Yes, you're right, Sampan. It would remain the same. Great. I think we don't have questions. So there are four components of a chart, the open, the close, the high, and the low. And we saw all of these. Again, just to reiterate, open means the price at which the stock began trading for that day. The high is the highest point at which the stock went for that day. The low is the lowest point at which the stock went for that day, and the close is that what price did the stock close in for that day. Now, as I said, that volume is a very important game. So one of the questions are, what are the candle charts which are not red and green? So mostly the candle charts would be red or green. If there are hollow candles, which means that the price did not really move throughout the day, which just means that it has been static. So let's say, for example, some days you'll not see much movement in the stocks, right? Some days you'll see that the price has not gone up and down much. So those days you can find some hollow candles, but mostly it will be red or green. When is it better to buy an action, and when is it increasing or decreasing the price? It depends. It very much depends on when it's better to buy. So of course, if the price is increasing, you want to ride that wave. So you want to uh, buy more of those, and then so that you can sell later. But if the price of the stock is decreasing, you want to kind of sell right now because the price is going to go down, right? So you want to sell right now and limit your losses than it going further. Or you could perhaps also we might go into this, it's called options trading. We could also kind of buy later on, like sell now and buy later to get the spread. uh why are there multiple candlestick charts in the same day for the same stock? There are not multiple candlestick charts. What there are is there are multiple highs and multiple lows. Sometimes, so the open and close for the same stock will be always the same, but there will be different highs at different points of the day. So when you look at, like, say, for example, trading at 11 a.m. Eastern time, it's going to have a different high and a different low. Then at 12, it will have a different high and a different low. So the more granular you go, the highs and the lows are different. So you also know that how the stock is moving to further think about what can happen to the stock and then take a trade. Yes, I think that's a great question. If a stock has a low value but large volume, how would that pattern show? So we'll go into volume now, and then we'll answer this question. So volume is like the total number of shares traded during the period. A high volume with price increase means there's very strong bullish sentiments on that stock. Whereas a high volume with price decrease means exactly the opposite, right? Strong bearish sentiments on that stock. Low volume means there is a very weak trend. So low volume means that not a lot of people are interested in the stock at this point of time. So say if you're thinking that I want to make a move on this security, on this stock, and you buy it, but there are not a lot of people interested in that stock. So when you try to sell it, not a lot of people are interested in buying. So at the end of the day, it's plain economics, right? There's a supply and then there's a demand. So if the demand is not big, right, then even if you have a good amount of supply, whom will you sell it to? So you'll not be able to get the price you want on that stock if you don't have people who are going to buy it from you. That's why a low volume says weak trend, and possibly people are just waiting it out. People are thinking that the stock will move the exact opposite direction. So if you're a spot trader, if you have a weak trend, a low volume, then probably don't trade in that stock at that point of time. So when you have a high volume with price increase, definitely go in, because there's more appetite for that stock. So you can buy at certain point and then sell at a certain point, because there will be more people wanting to buy it. And there will be people who will be seeing the stock go up and get interested in that stock and start buying it. So yeah, volume is very, very, very important. So the greater the number of shares being traded during that period, the better it is for the stock, and the better it is for you to be a spot trader. So one of the things that intraday trading relies on is identifying the support and resistance levels. What it means by when I say support and resistance levels are the fact that uh, at certain point, when the stock is going up and down, at a certain point, the stock starts saturating. It does not go beyond a certain point, and that becomes its resistance level. So within intraday, charts show price movement, say in a 1 minute frame, 5 minute frame, 15-minute frames, and 1 hour frames, right? So like you could look at how the stock is changing every 5 minutes, how the stock is changing, say every 15 minutes or an hour, right? Um, and so these are different time frames, right? Now it depends on what kind of a trader you are. If you are an intraday trader, you should look at intraday time frames. If you're a daily trader, you look at daily time frames, like what happened over the last 2 days and what's going to happen over the next 2 days. If you're a weekly trader, right, you look at what happened last week and how it's going to influence how the stock is going to move this week, and then monthly, right? So again, like I always say, the choice of the chart type and what kind of a time frame you want depends on what kind of a trading you're doing. So if you're a spot trader, if you are a short-term trader, if you are an intraday trader, you look at intraday and daily charts. You look at those 5 minute charts, you look at those 15-minute charts, and look at 1 hour charts. If you're a swing trader, like you're waiting for the stock to swing, right? You look at daily and weekly charts, because there are some stocks which go really up and down. They are really volatile, right? And then the third bucket is long-term investors who really don't care about intraday, daily, weekly, probably even not monthly. Like long-term investors will focus on like where the stock is gonna be over, like say a 3 month time frame, or like where the stock is gonna be in the next quarter, right? They really go quarter by quarter on what's happening. So it's about identifying your support and resistance levels. And the techniques for identifying your support and resistance are horizontal levels and trend lines, right? So horizontal levels are basically based on what are the previous highs and lows. So you look at, say, what happened yesterday, you look at what happened 15 minutes back, you look at what happened 1 year back, and then you look at what are the support and resistance levels. So say you look at a stock, say over a week, right? And you see that it's not falling beyond a certain point. Like say, every time the stock reaches, say, $50, and then it again goes back up somehow, and then it again falls, and again it comes to $50, and it again goes up. So then $50 becomes a very strong support and resistance level for you, which means that there's very low chance, very, very low chance that the stock is gonna go farther down that $50. So then you know that like you, as soon as it is 50 or near 50, you want to buy, right? Because you know that after 50 the stock is going to go up. So and then similarly, we will also see the next slide, the top. So there's always a top, and you sell when it's at the top and buy when it's at the resistance level, right? So whenever it's near 50, you want to buy, because you now know that it's a resistance level. The stock is gonna start going up as soon as it touches 50. So you'll try to build trend lines of that. Basically, how does the uptrend line look like? How does the downtrend line look like? And the more times a trend line is touched, the more significant it becomes. So if you look at, like, there has been, say, 8 occurrences of the stock not going beyond 50, it gives you more data points and more courage to buy around the 50 mark, because you know that there's a very, very high chance that the stock is going to start going up. So there are different techniques for identifying support and resistance. One is, of course, looking at moving averages. And if you look at the picture on the right, you'll see that those are what is called trend lines. So you kind of build a trend line as to like what has been the top, like how much has the price gone up, and what has been the bottom, right? What has been the resistance, and then you build a trend line on that. So it moving averages is calculated by averaging a stock's closing prices over, say, a different number of periods, right? So most common which you'll get in Google Finance and Yahoo Finance are 50-day periods, 100-day periods, and 200-day moving averages. So when you see that there's an uptrend, when you see there's an uptrend in the stock, the moving averages act as dynamic support, right? And in a downtrend, moving averages act as a dynamic resistance. So so think about it this way: like if a stock's price is above its 200-day moving average, uh, that average serves as a support, right? So you know that if the stock is falling and it's falling and it's falling and you're very worried, just look at what's the 200-day moving average. And when you look at the 200-day moving average, you know that at that point there's a very high chance that the stock is going to saturate and not go beyond that. It's gonna then start its journey upwards. It's more about recognizing common chart patterns than about, like analyzing, because when you start looking at charts, you'll see that there are mainly two types of patterns. One is continuation and the other one is reversal. So in continuation, it suggests that the trend will continue after a pause, and in reversal, it indicates that the trend is likely to change direction, right? And the reliability of the pattern will definitely be better uh, with the greater amount of time that it has spent, right? So and the time period you take to analyze it. Uh, it's going to get better with the size of the pattern, and of course, like I said, volume. Its volume is a very, very important part. Uh, if you look at the cheat sheet on the right, you look at how you can look at bullish wedges, how you could look at bearish ones, and like you look at your entry points, you look at the stop loss, and you look at the one on the top. Uh, this kind of gives you a better understanding of where the stock might reach and kind of settle, and how up can the stock go once it has settled down and starting its journey up. How far can it go if, say, everything else remains the same? Now, suddenly say there's a trend, or suddenly say there's a new thing, new initiative that the company is doing. Well, it might go beyond the top that it has attained, before. But if everything else remains same, it probably will gonna reach there and then start its way back again. Now, there are three kinds of continuation patterns, right? One, there's triangles, there are flags, and then there are pennants. Uh, Again, if we go back to the one, you'll see that there's an ascending triangle, there's a descending triangle, right? So an ascending triangle means a bullish continuation, whereas a descending triangle will mean a bearish continuation. Uh, a bullish wedge, and we can see a bearish wedge. A bullish flag, and we can see a bearish flag. So when you see these patterns evolving over, say a 15-minute chart or a 1-hour chart or even a weekly chart, you know what is going to go next, right? So if you see a continuation chart, which is an ascending triangle, you know that the stock is bullish and it's going to go up from there. Whereas you see a descending triangle and you feel like, yes, this stock is bearish at this moment and might go down. So when you look at triangles, as we saw, there are symmetrical triangles, ascending triangles, and descending triangles. Symmetrical triangles means that it can go either way, and you really don't know. So you just have to wait it out. An ascending triangle means there's a bullish pattern in an uptrend, right? And a descending triangle, like we just discussed now, means that a bearish pattern in downtrend. And then we have flags. So a bullish flag would be downward sloping in an uptrend. A bearish flag would be upward sloping in a downtrend. And it usually resolves. Again, if we go back and we look at the bearish flag and the bullish flag, if you look at them, the bullish flag will kind of show you that it's moving upwards, whereas a bearish flag, if you see, is showing you it's moving downwards. So, and lastly, the pennants, it's similar to flags, but with converging trend lines. It kind of forms after there's like a certain spurt in the stock. So basically a sharp move, and you can expect it to have a brief pause, means the stock is not gonna change much for some time. And that's what the pennants are gonna tell you. And then we have reversal patterns, right? And reversal patterns, we normally have six kind of patterns. One is the head and shoulder pattern, the double top pattern, the falling wedge pattern, uh, and the reverse of all of them. So what head and shoulder means, right? Bearish. When if you look at top reversal, right? If you look at the first chart, the left shoulder, higher head, right shoulder with the neckline, well, that confirms when price breaks below the neckline, which means that there's a reversal in prices, which means that it has reached the top and now there's a high chance that it's gonna go down now. A bullish, which means a bottom reversal, right? If you look at an inverse pattern, confirms when price breaks above the neckline, right? So if you look at the last one, that's an inverse head and shoulder pattern, which means that there's now gonna go get bullish. Whereas if you look at the first chart, you'll see that this pattern is when it's kind of getting into reversal mode, so it's gonna go down. Double top patterns are two similar peaks suggest resistance, and then double bottom bullish, which means that two similar troughs suggest support. So if you look at the second chart, which shows two similar peaks, it suggests resistance, which means that there is a resistance there and the price will not be able to break through that resistance that has been formed over there. Whereas the double bottom pattern, which you see on the third, that two similar troughs suggest that there is a support down there. So the price is not gonna go beyond that on the downtrend. It's only gonna move up from there. And then we have wedges. There's a rising wedge, there's a falling wedge, and basically both suggest that there's not a lot of momentum on the stock, and there's a high chance that the stock is going to reverse. So if it's going up, there's a high chance that it's going to go down now. And if it's going to going down, there's a high chance it's going to go up now. So it's basically shows you reversal patterns. Now, as much as a lot of us would really like, to be intraday traders, to be technical analysts, but there are huge risks of solely relying on technical analysis, right? Everybody wants to make some quick money. They just want to, see how the chart is performing, take a bet, and pray to God that they make a profit out of it. But there's good a number of risks that are involved by solely relying on technical analysis. One is definitely a self-fulfilling prophecy risk. If many traders follow the same technical signals, it can temporarily move the market in the predicted direction, right? And if it moves in the predicted direction, then you're not gonna make a lot of money, right? Because everyone is betting on the same thing. Think about it, right? Like, say, for example, think of it this way, right? You're playing a lottery and you know that the number 99 is going to win. Now, what if a lot of other people also know that the number 99 is going to win? So they're all going to place their bets on 99. Now, if the lottery money is like $1 million, and there are a huge number of people who bet on 99 and 99 won, then it's going to get divided, right? So the profit, that $1 million is going to get divided in greater number of people. So your profits are not going to get so high. So if you are seeing something, definitely there is someone else who's seeing that same thing, and they are also going to bet on that same move. Second would be past performance fallacy, right? Technical analysis assumes that past price movements predict future ones, right? And here's a question for you guys, right? Did anyone, like leave aside me, like the best market analysts, did anyone think that Nvidia, the stock price, would move the way it has moved over the last 1 month? Nobody, right? Because uh, if you look at just technical analysis, it will only tell you how far that stock can go, or because of what happened historically with it. Now, historically, we did not have AI, right? Historically, we did not need so many chips, but now we do. And that's why Nvidia is moving at the fastest pace. Its stock price has been moving at the fastest pace over the last 2-3 months. The third would be ignoring news and events, right? Like, say, for example, uh, if you're not following the trend, if you're not following the news, if you're not following what the company is doing, uh, technical analysis will not account for these events, right? It will not account for these regulatory changes, geopolitical changes, and whatever is happening, right? They will kind of predict based on what has happened with the stock in the past. Now, what has happened with the stock in the past uh, can only guide you to a certain extent, because it's not never going to tell you what's exactly happening live at this moment, right? Like, say, for example, uh, if you're not following the news, you'd not really understand that what kind of regulatory challenges is Walmart facing in Brazil, right? My past example. Now, if you don't know what are these changes, what are these obstructions that it is facing, your analysis would kind of only help you think that the market has expanded, when in actuality, the market might not have expanded at all. They might have been facing a lot of headwinds into moving into Brazil, right? And the other one would be over reliance on one indicator. So many new traders fixate on a single indicator, like something like an RSI, right? Without really understanding its limitations. There is no, trust me, there is no single indicator that can tell you, yes, this is going to move up just if you follow this indicator. The stock is going to move down if you just follow this indicator. There's absolutely not a single one that kind of predicts it and predicts it absolutely properly, because then everyone would do that and everyone would make a ton of money. Um, the other ones would be data mining bias, right? When we look at patterns and indicators, it's very easy to pick the one that fits what we want it to happen, right? Like, say, for example, you see that Nvidia has grown over the last, say, a year, right? And you feel like, or deep inside, you think your gut says that it's gonna grow and grow more. Now, you inherently, because of your bias, will look at certain events or certain stock patterns which tell you that yes, it will grow. And we will learn about this in behavioral finance. It's very true. It's at the end of the day, we are human, right? And we want something to happen. We want it bad. Uh, we try to find ways to back it up, to back up our thesis, because that's the way a human brain works. We first form hypothesis in our mind, and then we go about searching for data to prove that hypothesis, right? Um, then we would have, you'd miss the big picture. You focus on short-term charts, you miss the larger trends, right? False signals, there will always be false breakouts. Like I said, you might not know everything that's happening in the market, right? You see that a price is going down. Say you pick up a stock, like, say, stock X, and you see the price going down of that stock, and you feel like, oh, it's going down, so I should sell. But what if, and because you don't know, what if there is a huge fund who had a huge amount of stocks of that company is just selling right now because they want to exit? So, but the company is actually solid. So you miss out on a solid company because you just saw a trend, because you just saw the price going down, right? Fast moving indicators like MACD, can give repeated buy sell signals in choppy markets, which is absolutely not the true signal that you want to follow. And neglecting volume. Some traders focus solely on price patterns without considering volume, which is crucial, right? And we spoke about this just like 20 minutes back. Volume is one of the main features when understanding technical analysis. Like if there's not a strong volume in the stock, it means that the stock is very weak at this moment of time. And if you want to buy, there are not many sellers. If you want to sell, there are not many buyers. So you just want to maybe wait it out at this point of time. And that's it for today.